Before we start this video, do like and subscribe to our channel and not miss on any updates.
Let's start with the first topic, which is your preliminary or the introductory topic. So we'll first start with the Companies Act 2013. So under the Companies Act 2013, there are 11 chapters which we are going to discuss, which we are going to study. 11 chapters, chapter number 1 to chapter number 10. Here we are going to discuss section 1 to 148. So section 1 to 148 will be covered here under chapter number 1 to 10. And in chapter number 11, we have a separate topic which is with respect to foreign companies. Part of Companies Act which deals with foreign companies is what we are going to study here. So sections 379 to section 393 are going to be discussed here. So we'll discuss section 379 to 393 there in chapter number 11. So 1 to 10, section 1 to 148. Chapter 11, section 379 to section 393. Now, we'll first start with the basic and introductory chapter, your chapter 1. So, chapter 1 is all about the basics of Companies Act and how did the Companies Act come into existence, what is the date, on which date it received the presidential assent, and all the sections. So, definition sections, section 2, section 1, all of these sections are discussed in your chapter 1. So, talking about the definitions which have been given in chapter 1. So, there are several definitions. If you take your study material and have a look at the first chapter, it consists of almost all the definitions which are given under section 2. However, what we are going to do is, we are not going to cover up all the definitions right now. Why? Because it will become very difficult for you to understand so many terms, and when the term will come later on, you'll again have to come back to this lecture and understand what was the meaning of the term. So what we are doing here is, we will study some basic definitions here, the definitions which we'll need and which are very basic. Those basic definitions, we'll do them here in this chapter. However, with respect to the other definitions which are there, those definitions we will cover in the respective chapter. Whenever that term comes up, I have taken the definition there and we will understand the definition there, because that makes more sense. Studying all the definitions at once will not help in any manner. So, how we have made our study material is, in chapter 1 we have some definitions. However, if you compare it with the ICI study material, you will find that the number of definitions is lesser than what is given to you in your ICI study material. But do not worry, we are covering all the basic definitions here and all the other definition sections as in when the term arises in different chapter. In whichever chapter the term is going to be used, we will do those definitions there in that chapter. So do not worry, we will cover all the definitions, however, as and when required. In chapter 1, we will cover only those definitions which are important and which are basic and which are required to begin the Companies Act, because if you do not know the basics, starting the Companies Act will become difficult. So let's start with chapter 1, let's start with the introductory part of the Companies Act 2013. So what was this act made for? Or if you know that before the Companies Act 2013 came into existence, there was another Companies Act 1956. So what was the need of changing the 1956 Act and bringing an altogether new act in existence? The reason was very simple. In 1991, few industrial policies came in, which was your LPG reforms, liberalization, privatization and globalization. And apart from it, there were several reforms which were being brought in the country every year. Now this Act of 1956 did not address many things, and this Act of 1956 was also very stringent. and was very lengthy. So the government, they thought that there's a need that we bring in an upgraded and updated version of the Companies Act and also address the problems which have not been addressed by the previous act. So that is where they started making the Companies Act, the new Companies Act, and finally in the year 2013, this act actually came into existence. So that is how the shift happened from 1956 to 2013. It was a very important shift and a very significant one. So when we talk about the Companies Act 2013, what was this made for? It was introduced to consolidate and update the laws relating to the companies in India. So this is basically the preamble of the act. What is a preamble? Preamble specifies the scope and the power of the act. So it was made to consolidate and update the laws relating to companies in India. So this is a law which specifically relates to the companies. It was enacted to adopt the evolving national and global economic environment and to support the country's economic growth. So since the global economic environment was evolving at a very faster pace, this act was made in order to keep that pace, to match the pace of the economic growth. So the presidential assent was received on 29th August 2013 and was notified where in the official gazette on 30th August 2013. So this can be an MCQ type of question. When did the Companies Act receive its presidential assent? When was it notified? When did Section 1 come into force? It came into force on 30th August 2013. So upon notification, Section 1 came into force. 98 sections were enforced on 12th September 2013. So 98 sections, not all the sections. So when the Companies Act was initially made, it had 472 sections. 2 sections were deleted and now it has 470 sections. So out of those sections, 98 sections were made applicable from 12th September 2013. 143 sections from 1st April 2014 and other were notified later in phases. Now, why do you think there are different dates given for implementing different sections? The reason for it is the already existing companies, they were already following the Companies Act 1956. And to make a shift from 1956 Act to the 2013 Act, it does take time. So if you remember in 2017 when GST had come in, people had to shift from service tax to GST, excise duty to GST. So there is a transition required. You cannot make something applicable immediately. Now if I tell you that stop this lecture and start with the concept of cost accounting, how does it make sense? You should first know some basics. You should first know some basics of different subjects and only then you will be able to go do cost accounting. If you are told that directly go and start with taxation, or if someone tells you that directly go and start with audit, before starting those subjects you should know the basics of those subjects, right? So similarly here as well, people were already following Companies Act 1956. The companies already in existence were already following Companies Act 1956. There were different provisions in 1956 Act and the 2013 Act. So since there were different provisions, transitioning from the old provision to the new provision takes time. So that transition period had to be given to the companies so that they become acquainted with the Companies Act and shift their books of accounts, shift their companies' records from the 1956 Act to the 2013 Act. It takes time. That is the reason why the Companies Act 2013 was made applicable in a phased manner. Was not implemented once and for all, but rather in a phased manner the implementation had taken place. Now, when I say that this was made applicable in a phased manner, one very interesting thing about the Companies Act 2013 is that we say that it is made on a skeleton based approach. or it has a skeleton based structure. Why is that so? Because the Companies Act 2013 was made in a very systematic manner. Like the skeleton is very systematic. Similarly, the Companies Act 2013 also was made in a very structured and a systematic manner. That's the reason why we call it a skeleton structure or a skeleton based approach. That was another problem of 1956 Act. It was not structured. It was very unstructured. So Companies Act 2013, when it was made, it was very structured and it is made on a skeleton based approach. So talking about the Companies Act 2013, it is a rule based legislation. So the sections are only 470, but there are several rules in the Companies Act 2013. If I compare this with the 1956 Act, 1956 Act had over 600 sections, however lesser rules. However, this Act 2013, it has 470 sections but more rules. Why more rules? Because if there are more rules, it makes it easier for people to apply the act, because if you have a specific rule made for a particular thing, it is easier for people and companies to apply the act. So this is a rule based legislation with 470 sections and 7 schedules, again divided into 29 chapters. 470 sections, 7 schedules and 29 chapters. Each chapter has its own rules. So every chapter is supported by its own rules. What is the focus of this topic? What is the focus of this act? It is on improving corporate governance, simplifying regulations and protecting the interest of investors. So these are the basics, or these are the basic focus points of the Companies Act, that they want to improve the corporate governance, simplify the regulations and also protect the interest of the investors. This act modernizes India's corporate legal framework and brings it in line with the international standards. So the Companies Act 2013 has given a modern touch to the Indian legislations and also has brought it in line with the international standards which are in place. Now, starting with section 1 of the act, what does section 1 of any act talk about? Short title, extent and commencement. So section 1 of the Companies Act deals with the title of the act, according to which this act may be called the Companies Act 2013. So this is the title. Further, section deals with extent to the applicability of the act. So this act is applicable to whole of India. So Companies Act 2013 is applicable to the entire country. It is applicable to the whole of India. Now, starting with another section which is again a part of section 1, however, it gives us to which different types of companies is this act applicable. So section 1 subsection 4 gives us the applicability of the Companies Act. Now, to which companies will the Companies Act apply? It will apply to all the companies which are incorporated under this act. This act means what? The Companies Act 2013 or any other previous company law. So what is the first company to which this act is applicable? Companies incorporated under this act or previous company law. So all the companies which are incorporated under the Companies Act 2013 or any other previous company law means what? Companies Act 1956 or any other company law which was there in existence before that. So why previous company law is also taken into consideration? See, if we have only one Companies Act in existence and we say that this will be applicable to only the companies which are made under this act, how does it make sense? What will happen to the companies which have already been incorporated? Will they shut themselves down and register themselves again? No, that is a very big problem and it will cause a lot of chaos. That is the reason why the definition that is the reason why the applicability section itself states that this act will be applicable to all the companies which are formed in this act. If you are registered under this act, then you will have to follow this act. However, even if you are registered under any previous company law, no problem, you will have to comply with Companies Act 2013. This act is applicable to your companies as well. Apart from these companies, this act is also applicable to insurance companies, banking companies, and electricity companies. So this act is applicable to insurance companies, banking company and electricity company. However, there is one exception which comes up here in case of all of these three companies. Now what is that? The exception is wherever the provisions of Companies Act are inconsistent with the specific acts the specific act shall apply. So what does this section say? This section says that wherever the provisions of the Companies Act are inconsistent with the provisions of specific act. Which specific acts are we talking of? Specific act in case of insurance company is IRDA Act or Insurance Act. In case of banking company, it's Banking Regulation Act. Banking Regulation Act. And in case of electricity company, it is again Electricity Act which applies there. So if there is any inconsistency in the provision, now what inconsistency could be there? See, the Companies Act 2013 says that if you want to prepare your financial statements, profit and loss balance sheet, you will have to follow the Schedule 3 of the Companies Act. Schedule 3 has to be followed by companies whenever they have to prepare their profit and loss account and balance sheet. However, the format of profit and loss account and balance sheet of these companies, insurance, banking and electricity, have been specified in their specific acts as well. And it is different from what has been given under Schedule 3. Then what will the companies follow? Will they follow the Companies Act or will they follow their specific acts? So in such a situation wherein there is any inconsistency means what? The Companies Act says something else and the specific act which is applicable on those company talks about something else. Then in that situation, what will be applied? We will apply the specific act which is applicable to those companies. We'll apply the specific act which is applicable to those companies. We will not apply Schedule 3. So that is what this section also says, that this act is applicable to insurance companies, banking companies and electricity companies. However, wherever there is inconsistency, the specific act should apply. See, the specific, if there is something specific, we always apply the specific act. Then, this act is also applicable to certain companies which have been formed under some special act. If there are certain companies formed under some special act, the examples for this could be, say, NHAI, could be SBI, So this act is applicable to these to the companies which have been incorporated under special act as well, or any other company or body corporate which is notified by the government, which may be notified. To them, the Companies Act will apply. So a very easy and a very interesting section which talks about the applicability of the Companies Act 2013. Let's now have a look at the section. So what does it say? It says the provision of Companies Act apply to all companies incorporated under this act. This act means what? Companies Act 2013 or any previous company law. So if your company is formed under this act or previous company law, this act is applicable. Then it is applicable to insurance company unless the provision conflicts with which act? Insurance Act or IRDA Act. IRDA is Insurance Regulatory Development Authority Act. It is also applicable to banking company unless it conflicts with Banking Regulation Act. Electricity companies unless the provisions conflict with Electricity Act. This is also applicable to companies which are governed by special act to the extent there is no inconsistency. Again, if there is any inconsistency with the special act shall prevail. Any other body corporate notified by central government subject to some exceptions or modifications. So this is what? This is the applicability of the Companies Act 2013. To which type of companies is this act applicable, and to what different types of companies is this act applicable, where will we apply the Companies Act 2013. So that is what we have discussed here under section 1 subsection 4. Now let's discuss about what are the characteristics of a company. Now we'll quickly brush up through this because this is something which you have done at your foundation level. So let's quickly understand what are the different characteristics of a company. So the first characteristic of a company is that it has a separate legal entity. So as soon as the company is incorporated, what happens? It gets a legal status of its own. It is distinct from its members. It is distinct from the people who have incorporated the company. So company, it is a legal person which has a separate status. So company and members, they are different persons. And if you remember, there's a landmark case law which discusses about separate legal entity, and that is Salomon versus Salomon Company Limited. So this emphasizes on the fact that there's a wheel between the company and its members and it separates their personality. So the first characteristic of a company is that it has a separate legal entity. Then the liability is limited. Whose liability is limited? Is it the company whose liability is limited, or is it the members' liability? The answer is, smart CAs always say that it is the members whose liability is limited, the company's liability is not limited. Why? Because in the case of winding up of the company, all the assets of the company are sold off and the liabilities are paid off. So how can you say that it is the company whose liability is limited? No, it is the members of the company whose liability is limited. Now again, to the extent of limitation of liability, it depends on the type of company it is. Then the company enjoys perpetual succession. Perpetual succession means what? Members may come, members may go, but the company will go on and on unless and until it is legally wound up. So the existence of company will not be impacted by the change in the members of the company. The members may come, members may go, members may die, but the company's existence will not be hampered. So perpetual succession means what? We say that the company is going to go on forever unless and until it is going to be legally wound up. Then company is an artificial legal person. Why artificial person? Because it does not get natural birth. And it is a legal person because it is formed under an act, it is formed under a law. We call company a legal person. which means what? Company can purchase assets in its own name, can hold assets in its own name, can sue someone or can be sued upon in its own name. So company has the ability to enter into contracts in its own name just like any other person can. However, does it take natural birth? No. So that's the reason why we call a company an artificial legal person. So see, there are two words, artificial and fictitious. What is fictitious? Fictitious is imaginary, but company is not imaginary. It is actually coming into existence, and that is the reason why we call the company an artificial legal person. And finally, a company may have a common seal. Earlier, having common seal for the company was mandatory. However, now it is not mandatory for a company to have a common seal. So if the company has a common seal, then all the important documents of company, the company shall affix the common seal. However, if there is no common seal, then two directors of the company shall sign on the important documents. And if it is a company where a company secretary has been appointed, then one director and one company secretary, like this, two people shall sign on the documents of the company. So all in all, these are all some very important characteristics about a company form of organization. Let's now start with some important definitions. Let's begin with section 2. So before I start with section 2, one important fun fact about section 2 of Companies Act is that the definitions in section 2 have been written in an alphabetical order. So they have been structured in a form that all the definitions are given to us in alphabetical order. No, this does not happen in case of every act. I'm sure this question would come to your mind as to does this happen in case of every act? So the answer is no, this does not happen in case of every act. This is only the Companies Act where the definitions in section 2 have also been written in an alphabetical order. So let's start with the first definition. This is the definition of article. What does article mean? So whenever we have this term article, it basically means the articles of association of the company as they are originally formed. So what is an article? It is the articles of association of the company or as altered from time to time. So articles of association as altered from time to time, applied in pursuance of any previous company law or in pursuance of this act. So articles means what? Articles of association which are originally framed or as altered from time to time and as applied as per any previous law or as per the Companies Act 2013. So what are articles? They are nothing but the articles of association of the company. Those are the company articles. Moving ahead to the next definition. So the next definition is about an associate company. So what is an associate company? An associate company in relation to another company means company in which that other company has significant influence, but which is not a subsidiary company of the company having such influence and includes a joint venture company. So what does significant influence means? Significant influence means control of at least 20% of the total voting power or control of or participation in business decisions under an agreement. What does joint venture mean? It means a joint arrangement whereby the parties have joint control of the arrangement, have rights to the net assets of the arrangement. So that is a joint venture. So what is an associate company? Associate company is where the other company has significant influence. Let's understand this with help of an example. Let's say there's a company, Greenwood Limited. Now this company, Greenwood Limited, has 30%, has control over 30% of the total voting power in the company Plywood Limited. So what is happening here? Greenwood Limited has control over 30% of the total voting power of Plywood Limited. Can we call it significant influence? In this situation, we say that Greenwood has significant influence over the other. Other means what? Over Plywood Limited. So what does the definition say? Definition says associate company in relation to another company means a company which the other company has significant influence and which is not a subsidiary company of the company which has such significant influence, and it also includes a joint venture. So what is an associate company? It is in relation to other company where the other company has significant influence. So now in this situation, Plywood and Greenwood, they become what? They become associate company. Why? Because Greenwood Limited has significant influence in the company. When we talk about significant influence includes two things. When do we say that a company has significant influence over the other? The first situation is where it controls at least 20% of the total voting power. Mind it, it is not the total share capital, we are talking about the total voting power. So at least 20% of the total voting power. Or what does it do? It controls business decisions, some significant business decisions which are made. If any of the criteria is satisfied, we say that there is significant influence. See, what does significant influence mean? Control of at least 20% of the total voting power or control of or participation in business decisions. If any one of the point is satisfied, we say that there is significant influence. So what does significant influence mean? Control of at least means what? Greater than or equal to 20% of what? Total voting power. How do we calculate total voting power? We take into account only the shareholders who have voting power. Which shareholders have voting power? It is only the equity shareholders which have voting power. So we calculate the voting power taking into account only the shareholders who have the voting power. So we calculate voting power on that basis. So if there is control of at least 20% of the total voting power, or where there is a company which participates and controls the business decisions, then we say that there is significant influence. Either this condition or this condition. Any one condition satisfied, we say that there is significant influence. And when there is significant influence, then the companies become associate company. So what is an associate company? Where one company has significant influence over the other. What does significant influence mean? Significant influence means that one company controls at least 20% of the total voting power in the other company, or participates or controls in the business decision. So those type of companies are associate companies. So that was the definition of associate company defined in section 2 clause 6. Moving ahead to the next definition. Now this is the definition of a body corporate. So what is a body corporate? Body corporate or corporation includes a company incorporated outside India but does not include a cooperative society registered under the Cooperative Societies Act and any other body corporate which the central government may by notification specify. So in simple terms, if I talk about a body corporate, it includes a company incorporated outside India, which means that it includes a foreign company. See, the definition, the meaning of company in the Companies Act 2013 does not include a foreign company. Why am I saying this? We'll understand when we do the definition of company. But for now, just understand when we talk about a body corporate, what are the components of a body corporate? So it includes Indian company, foreign company, Indian LLP, foreign LLP. So Indian company, foreign company, Indian LLP, foreign LLP, all of them comprise of the body corporate. And when we talk about a body corporate, it has some specific exclusions like the cooperative societies, or any other body corporate which has been specifically notified by the central government. So that is what a body corporate means. The meaning of body corporate is very, very important. Do remember this one, this point, because as we move ahead, we'll be using it. Then comes in the definition of company. What is a company? Company means company incorporated under this act. This act means the Companies Act 2013 or under any other previous company law. So, what is a company? What is a company as per the Companies Act 2013? Company means a company incorporated under this act or any other previous company law. This act means what? The Companies Act 2013. It is a company which is incorporated under this act. What does this act means? It means the Companies Act 2013. Okay. So which companies are incorporated here? These are all Indian companies only. Then previous company law could be the 1956 Act or any other previous act which was there in existence before 1956. So what is a company? A company which is incorporated under this act or any other previous company law. Now whether it is the Companies Act 2013 or the Companies Act 1956 or any other previous company law for that matter, any company which is being incorporated under these acts will be an Indian company only, because these acts are applicable to India. So the company which will be incorporated under these acts will become the Indian company only, which means what? The definition of company in the Companies Act does not include a foreign company. The definition of company, it does not include a foreign company, which means what? Wherever in the entire Companies Act you read this term company, you come across this term company, wherever in the entire Companies Act, it is only talking about the Indian companies, it is not talking about the foreign company at all. So in the entire Companies Act, whenever you come across this term company, it is talking about what? It is talking only and only about Indian company, not foreign company. So always remember, foreign company is not included in the definition of company as per the Companies Act 2013. Foreign company is not included in the definition of company. It is only then Indian company which is covered under the definition of company. So always remember, wherever this term company is being used in the entire Companies Act, it does not include a foreign company. And say you would get a question in your mind, so what if we want to include the foreign company in some definition? Then there will be an explanation given below the definition, or a specific proviso will be given below the definition which makes it applicable to the foreign company as well. So that is what a company means as per the Companies Act 2013. Moving ahead to the next definition. So it is the definition of a company limited by guarantee. What does it say? So company limited by guarantee means where the liability of members is limited to such amount as the members have undertaken to contribute. So see, on the basis of liability, the companies are of three types: limited by shares, limited by guarantee, then there's unlimited company. Okay, so if it is a company which is a company limited by shares, the liability of member is limited to the extent of unpaid value on share. So say the value of share is rupees 10. Rupees 6 have already been paid up on the share. What is the remaining amount? Remaining is 4 rupees. Remaining is 4 rupees. Now this 4 rupees, the member's liability is limited to the extent of only 4 rupees. The company cannot call any amount over and above 4 rupees from the member. So that is a company limited by shares. When we talk about a company limited by guarantee, here also the liability of members is limited. However, the limit here is to the extent of agreed amount of contribution. So to what extent is the liability limited here? Here the liability is limited to the agreed amount of contribution. So what happens is, when a person becomes a member in a company limited by guarantee, what he does is he gives a specific amount which he is ready to contribute to the company in the event of winding up of the company. So to what extent is the liability limited here? The liability here is limited to the extent of agreed amount of contribution. This is in which case? This is in case of a company limited by guarantee. Then comes an unlimited company. The name itself suggests the liability of members here is unlimited. So that is what the agreed amount of contribution here means. So undertake to contribute to the assets of the company in the event of winding up. So in the case of a company limited by guarantee, this amount of agreed contribution, it can be called upon only and only at the time of winding up of the company. This amount can be called by the company from its members only at the time of winding up. Can call the amount only at the time of winding up. Then the next type of company is a company limited by shares. So what is a company limited by shares? Again, the liability of members is limited, but to what extent? To the extent of unpaid value on shares which the members hold. Now when we talk about this unpaid value on share, when can the company call for this unpaid value on share? At any point of time. At any point of time, the company can call for this unpaid value on share. This can be called upon either at the time of winding up or whenever the company is in need of funds, the company can call for this amount. So this amount can be called at any point of time. However, in case of a company limited by guarantee, the amount could be called upon only and only at the time of winding up of the company. Then comes the next definition of a financial year. So what is a financial year? Means a period ending on 31st March every year, where it has been incorporated on or after 1st January, the period ending on 31st March of the following year, in respect whereof financial statement of company or body corporate is made up of. So what is a financial year? If we understand this in very simple terms, Financial year is a period starting from 1st April every year, ending on 31st of March. So financial year is what? It is a period starting from 1st April ending on 31st of March every year. Now when we talk about starting from 1st April and ending on 31st of March, in this situation, if say a company is incorporated after 1st of January, let's say 1st January of year 1. Ideally, when does the year end? It ends on 31st March of year 1, right? But in this situation, it says that if the company is incorporated on or after 1st of January of a year, then in that situation, for the first financial year, we will end the year on 31st March of year 2 of the following year. This is only for the first financial year, okay? Generally, normally the period is 1st April to 31st March. However, if a company is incorporated on or after 1st January, then in that situation, the financial year would end on 31st March of the following year. Following year means what? On 31st March of the next year. This is for only the first financial year. This is only for the first financial year, not for any year after this. So that is what the definition of financial year talks about. Let's now discuss about what is a government company. So let's see what a government company means. Government company is basically a company wherein not less than 51% of what? Of the total paid up share capital is held by either the central government or the state government, or partly by central government and partly by state government. Let's understand this with help of an example. Let's say there's a company ABC Limited. Now in ABC Limited, 40% shareholding is of the central government and 20% shareholding is of state government. So 40% shareholding is of central government and 20% shareholding is of state government. What is the total shareholding of central government plus state government? 60%. Which means now ABC Limited is a government company. It is not necessary that the central government should alone hold more than 51% or at least 51%, and it is also not that the state government should alone hold the amount. The percentage of paid up share capital can be held either by the central government or by the state government or partly by center and state. That type of company is a government company. Let's now have a look at the definition of government company. So what is a government company? Government company means any company in which not less than 51%. Not less than 51% means what? Greater than or equal to 51% of what? Of the paid up share capital. It is paid up share capital here, it is not the total voting power. Is held by whom? Either the central government or state government, or partly by center and partly by one or more state governments. It also includes a company which is subsidiary of a government company. Now say ABC Limited in our example was a government company. So ABC Limited, say subsidiary is XYZ Limited. Since ABC Limited is a government company, XYZ Limited will also be treated as a government company. So subsidiary of government is also treated as a government company. Subsidiary of government company is also treated as a government company, just like we do it with a public company. Let's now move ahead to the next definition. The next definition is of a holding company. What does the holding company mean? So holding company in relation to one or more other companies means company of which such companies are subsidiary company. So what is a holding company? In relation to one or more companies means a company of which such companies are subsidiary companies. So in order to understand the definition of holding company, it is important that we first have a look at the definition of subsidiary company. So what is a subsidiary company? Let's first understand this with help of an example and then we'll come back to the definition here. So talking about a subsidiary company. What is a subsidiary company? Let's say there's a company HUL Limited. This is an Indian company. Now in this company, let's say approximately 65% of total voting power is held by another company, the name of which is Unilever Limited. Now Unilever Limited is a foreign company, it is not an Indian company. So in this situation, what do we say? We call Unilever Limited as the holding company of Hindustan Unilever Limited. So what has happened here? What is Unilever Limited holding? More than 50% of the total voting power in the company. See, voting power in a company lies with whom? It lies with the equity shareholders. Equity shareholders, they have the voting power in a company. Let's understand this with help of an example as to how do you calculate the total voting power. Let's say there's a company wherein there are 2 lakh shares, and out of these 2 lakh shares, 1 lakh are equity shares and 1 lakh are preference shares. The value of share is rupees 10 each. Now, with respect to the total voting power, it is only the equity shareholders in this company who have voting power. Preference shares holders do not have any voting power. So what is the total voting power equivalent to? Total voting power will be equivalent to 1 lakh equity shares. So let's say 1 lakh is the total voting power in the company. Let's say there's a company which holds 50,000 equity shares in this company. So what is the percentage of total voting power which this other company holds? It is 50%. 50% of 1 lakh. So this is how we calculate the total voting power. However, when we are saying total share capital, we take the entire 2 lakh into consideration. So there is a difference when we are set to calculate total share capital and total voting power. Total share capital includes both equity as well as preference share capital. However, total voting power, it takes into account only the shares which have voting power, and that's how we calculate the total voting power. So when does a company become a subsidiary company? When the other company exercises control over more than 50% of the total voting power. More than 50% of total voting power. Control over more than 50% of the total voting power, either on its own or together with one or more subsidiary companies. So if the other company exercises control over more than 50% of the total voting power, then it becomes the holding subsidiary company. Or the second situation is controls the composition of board of directors. Controls the composition of board of directors. Controlling composition of board of directors means what? Power to appoint or remove majority of directors. Power to appoint or remove majority of directors. So there are two situations wherein the holding subsidiary relationship is established. One, where one company is controlling the composition of board of directors in the other company. Then in that situation, the company who is controlling the composition of board of directors will become the holding company and the other company will become the subsidiary. Controlling composition means what? Power to appoint or remove majority of directors. Say there are 10 directors in a company. Out of 10, 7 are appointed by one X Limited. Then in that situation, we say that X Limited is controlling the composition of board of directors, and X Limited will become what? Holding company. Alright. And when we say controlling composition of board of directors, it is power to appoint or remove majority of directors. And when we say exercises control over more than half of the total voting power, what does it mean? Exercising control over more than half means greater than 50%. Not equal to, greater than 50%. Let's say there are two companies, A Limited and B Limited. A Limited has control over 51% of the total voting power of B Limited. Then in that situation, A Limited will become the holding company and B Limited will become the subsidiary company. Let's take another example. Let's say again A Limited, B Limited, Y Limited. Now A Limited is holding 25% of the total voting power of B Limited, and Y Limited is holding, let's say, 26% of the total voting power of B Limited, and A Limited is the holding company of Y Limited. So A Limited is holding, Y is its subsidiary. So here in the situation, what is the holding of A in B? 25%. Will it become the holding? No. However, A Limited along with its subsidiary, what is the total holding percentage of the holding as well as subsidiary? It is 51%. Is it more than 50? Yes. So now in this situation also, A Limited will become the holding company of B Limited. So either the company on its own, so in this situation it was holding on its own, and in the second situation it is holding more than 50% of the total voting power along with its subsidiary. So either the company on its own or along with one or more of its subsidiaries. Then in that situation, we say that the holding subsidiary relationship has been established. Now, when we talk about the holding subsidiary relationship, if say here the holding of Y Limited, if it was only 25%, then the total holding of both the companies would have come to 50%. In that situation, holding subsidiary relationship would not have come into existence. Why? Because in the given situation, the company is not exercising control over more than half. It has to be more than half. Equal to 50%, no holding subsidiary relationship. It has to be more than half. So, greater than 50%, only then holding subsidiary relationship will be established. Moving ahead, let's now have a look at the definition of subsidiary. So, what is a subsidiary company? Subsidiary in relation to another company, which means the holding company, is a company in which the holding company 1 controls the composition of board of directors or exercises control over more than one half, that is more than 50% of what? Of the total voting power, either at its own, either on its own, or together with one or more of its subsidiary company, either on its own or together with one or more of its subsidiary companies, provided that such class or classes of holding company as may be prescribed shall not have layers of subsidiary beyond the number. So, layers of subsidiary, I'll explain it in some time. Layers means, say A Limited is the holding of B, B is the holding of C, C is the holding of D. So, these are called as layers of subsidiary. So, they say that there are some specified layers as prescribed as per rule which should not be exceeded. Now, very important point. Now, in the entire definition of subsidiary company, the term which we have come across everywhere is what? Is company. The term which we have come across everywhere is company, other company, holding company, subsidiary company. Everywhere it is only company. And if you remember, we discussed some time ago that company, with respect to the Companies Act 2013, the term company does not include a foreign company. But in the example which I had taken when I started with explanation of subsidiary company, I took the example of HUL. I took the example of HUL and Unilever Limited, wherein Unilever Limited was a foreign company. Now, how can a foreign company become a holding company or a subsidiary company? Since the term used in the definition is only company, which it excludes a foreign company. So how can a foreign company become a holding or subsidiary company? The answer to this lies in the explanation. So if you come at the explanation, here the explanation specifically states the expression company includes any body corporate. So company here includes a body corporate. Body corporate includes a foreign company, as a result of which it can become a holding company or a subsidiary company. Moving ahead, what does it say? A company shall be deemed to be a subsidiary of holding even if the control is of another subsidiary company of the holding company. So like we've understood in the second example, A Limited along with Y Limited, they are holding it. And there's one more thing which says subsidiary of subsidiary is also a subsidiary. Say for example, A Limited is the holding company of B Limited, B Limited is the holding company of C Limited. A and C do not have any relationship directly, but because C Limited is the subsidiary of B Limited, which is the subsidiary of A Limited, by the virtue of holding subsidiary relationship between A and B, C becomes the subsidiary of A Limited as well. So which says subsidiary of subsidiary is also treated as a subsidiary company. Then controlling composition of board of directors means what? It shall be deemed to be controlled by another company if the other company exercise some power exercisable by it at its discretion to appoint or remove all or majority of directors. So if they have the power to appoint or remove all the directors or majority of directors, then we say that they have control over composition of board of directors. Now what does total voting power mean? Total voting power means total number of votes which may be cast in regard to the matter on a poll at a meeting of the company if all the members or their proxies have a right to vote, are present at the meeting and have cast their votes. So just like we calculate the voting in case of any meeting of the company, in a similar manner we are going to calculate the total voting power in case of a company. Moving ahead with another definition. Now the other definition is of KMP or key managerial person. Who are the people included, or who are the people who form the part of KMP of a company? The CEO or MD or the manager, the CS, whole time director, CFO, any other officer, however not more than one level below the director, who is in whole time employment of the company and who is designated as KMP. So it could include any person who is designated as KMP by the board, or any other officer as may be prescribed. So who can be a KMP? Who are KMP? CEO, MD, manager, CS, whole time director of the company, CFO of the company, or any other person who is designated as a KMP, who has been designated as a KMP by the board of directors of the company, or any other officer as may be prescribed. Now let's understand what is a listed company. Now previously the definition of listed company was very simple. It said a company whose securities are listed on a recognized stock exchange in India is said to be a listed company. However, now there are some changes which have been made to the definition of a listed company. Let's now have a look at what it says. So a listed company means company which has any of its securities listed on a recognized stock exchange. So one point is very clear. If the securities of your company are listed on any recognized stock exchange, could be NSE, BSE or any other recognized stock exchange, then your company is a listed company. And as per proviso, there is one proviso to this section which says certain companies shall not be considered as listed even if their securities are listed. So there is an exception here. Some companies will not be treated as listed companies even if their securities are listed on the stock exchange. When companies not treated as listed companies, one, public companies that have not listed equity shares but have listed any of the following on private placement basis. So a public company, it has not listed its equity shares but rather listed something else on private placement basis. What did they list? They list their non-convertible debentures or non-convertible redeemable preference shares or both. So what did they list? They listed their NCD or non-convertible. So they have listed either their non-convertible debentures or non-convertible redeemable preference shares. Then in that situation, they have not listed any equity shares. They have either listed their NCDs or non-convertible redeemable preference shares or both. No equity shares listed. Then we will not consider that public company as a listed company. That public company will not be treated as a listed company at all. Then private companies that have listed their NCDs on recognized stock exchange under private placement. So if a private company has listed its non-convertible debentures on a recognized stock exchange on private placement basis, then again not considered as listed. Then public companies whose equity shares are listed only on foreign stock exchanges but not in India. So if a company has listed its securities but on foreign stock exchanges, not in India, then in that situation also we are not going to consider it as a listed company. See, it says securities, and when the term securities comes up here, security includes shares and debentures. So even in certain situations, if debentures are listed, we can call a company a listed company. However, these are some exceptional situations wherein we will not consider the company as a listed company, though some of their securities are listed on a stock exchange. Now let's understand who is the member of a company. So member in relation to company means who? The subscriber to the memorandum, who shall be deemed to have agreed to become the member of the and on its registration shall be entered as a member in the register of members. So as you all know that there are people who subscribe to the memorandum of association of the company whenever the memorandum is made at the time of incorporation of the company. So what is he doing? He is subscribing to some shares of the company and he becomes the member of the company on its incorporation, and as soon as the company is incorporated, this person's name is entered into the register of members of company. So that person is referred to as member. And every other person who agrees in writing to become the member of the company and whose name is entered in the register of members. So a person who agrees to become the member of the company and whose name is entered in the register of members of company, that person is said to be member. Then every person holding shares of the company and whose name is entered as beneficial owner in the records of depository. Depositories are what? CDSL and NSDL. So these are your national depositories. So any person who is holding shares in a company, he will become the member of the company by virtue of his shareholding. Then what is net worth? So net worth is aggregate value of paid up share capital and all reserves created out of profits, securities premium and debit and or credit balance of profit and loss, after deducting the aggregate value of accumulated losses, deferred expenditure, miscellaneous expenditure not written off as per the audited balance sheet, does not include reserves created out of revaluation of assets, write back of depreciation and amalgamation. So in simple terms, if we have to write down the equation of net worth, so net worth is equal to paid up share capital plus reserves. However, which are these reserves? Reserves created out of profits it includes securities premium also, and whether debit or credit balance of P&L. And from this, what are we going to deduct? Minus any accumulated losses minus expenditure not written off as per the audited balance sheet. And when we are talking about reserves, reserves do not include any revaluation of reserve or writing back of depreciation or amalgamation. So reserves will not include any revaluation reserves. This include reserves only which are created out of profits, the securities premium and debit or credit balance of the profit and loss account. So this is how we are going to calculate the net worth of a company. Now let's move on to another very important definition, which is the definition of a private company. Let's understand what a private company is. So when we talk about a private company as defined under the Companies Act 2013 is a company which has some minimum paid up share capital, however the amount has not been prescribed yet. Minimum paid up capital as may be prescribed. Alright. Then in case of private company, there is a restriction on the maximum number of members. So restricts the number of members to 200. So there is a restriction on the number of members to 200. Then there is a restriction on issue of prospectus they cannot issue any prospectus and go to the public to demand for the purpose of subscribing to their securities, and their shares are not freely transferable. Shares not freely transferable. So such company is a private company. Such type of company is a private company. However, when we are calculating the number of members, the total number of members in a private company, there are some inclusions and exclusions. So how do we calculate the number of members, and who are the people who are not included when we are counting the number of members in a private company? Who are not included? 1. Employees of company, people who are in the employment of the company and who are also holding shares of the company. Say for example, you are an employee of Infosys and you also hold shares in Infosys. Then when they are calculating the total number of members, they will not calculate you. Infosys is a public company. This was just for an example. So if an employee is also a shareholder of the company, then we will not count the employee as a member. When we are counting the number of members, we will not count that employee. So employee not included. Then ex-employee. Ex-employee means what? A person who was previously the employee of the organization but now is no longer an employee. So ex-employee will not be included provided that he was allotted the shares allotted during employment. If the shares were allotted to him during the term of his employment, then in that situation we do not count the ex-employee as well. So employee not included. Ex-employees who were allotted the shares during the time of their employment, meaning say I am the employee of Infosys and when I was the employee I was allotted the shares. Now I leave the employment but I continue to be the member of the company. I continue to hold the shares of the company. That is called as an ex-employee to whom the shares were allotted during the time of their employment. And joint holders will be considered as one. Joint holders considered as 1. So if I am holding shares with some other person, we will not be considered as two different members in a company, we will be considered as only one member. So let's just take an example and let's understand it. Say for example, there are 200 members in a company, say 180 normal members, 10 employees, 5 ex-employees. Shares were allotted during the time of their employment. There were 10 joint holders. Joint holders 5 into 2. We hold 5 shares, however, we are counting them as 2 members, so 10. So in this situation, how many members are there in the company? 180, we will count them. Employee 10, will we count them when we are calculating the number of members in a private company? No. Ex-employees, we will not count them. And joint holder will not count them as 10, we will count them as only 5. So what is the total number of members in the company? Is 185. So what did we do here? We did not consider the employees, we did not consider the ex-employees. And joint holders, we considered them as 1. Let's now have a look at the definition. So what is a private company? Private company means a company having minimum paid up share capital as may be prescribed, and which by its articles there is a restriction on the right to transfer shares, except in case of one person company, limits the number of members to 200, provided that 2 or more persons hold 1 or more shares jointly, then we consider them as single members. So joint holders will be considered as 1. Provided further that persons who are in employment of the company and who have been formerly in employment of the company, were members of the company while in employment and continued to be the member after they left the employment, shall not be included in the number of members. So we will not include them when we are counting the number of members, and prohibits any invitation to the public to subscribe for any securities of the company. So a private company cannot issue a prospectus at all. Then comes a public company. So what is a public company? A company which is not a private company. So all the restrictions like the number of members, the issue of prospectus, restriction on transfer of shares, all the restrictions are not applicable in case of a public company. So what is a public company, not a private company? So restrictions of private company not applicable here, are not applicable in case of a public company. Has minimum paid up share capital as may be prescribed, provided that a company which is subsidiary of a company, not being a private company, shall be deemed to be a public company for the purposes of this act, even where the subsidiary continues to be a private in its article. Now what does it say? It basically says that if a company is a subsidiary of a public company, it is deemed to be a public company. So say for example, A Private Limited, this is the subsidiary of Z Limited. So by its articles, A Private Limited is a private company. However, for the purpose of this act, for the purpose of applying sections, it will be considered as a public company. Then, what does a share mean? Let's move on to the next definition. What does a share mean? It means a share in the share capital of the company, and it includes stock. What is a small company? Again, a very, very important definition, very critical MCQs can be asked based on a small company. So concentrate here. Small company means a company other than a public company. So what is a small company? Company other than a public company, which means what? A public company can never ever be treated as a small company. So what is a small company? Company other than a public company. Paid up share capital of which does not exceed 4 crores. So paid up capital not exceeding 4 crores. less than 4 crores or such higher amount which it may be extended to 10 crores if the government wants to extend, and turnover not exceeding 40 crores. Turnover not exceeding 40 crores. So the limit, threshold limits which have been prescribed is what? The paid up share capital not exceeding 4 crores, which means it can be less than or equal to 4 crores, and turnover not exceeding 40 crores, which means it can be less than or equal to 40 crores. So it is a company whose paid up share capital is less than or equal to 4 crores and turnover less than or equal to 40 crores, and both the amounts can be increased to an higher amount. However, again, this clause will not apply to which companies? A holding company, a subsidiary company, a section 8 company, or any company which is governed by some special act. Let's now understand small company with the help of few examples so that your concept of small company becomes even more clearer. So here we'll take up a few examples and we'll identify whether the company is a small company or not. Let's say the name of the company is A Limited. Paid up share capital is 3 crores, turnover is 30 crores. Is the paid up share capital within limit? Yes, it is less than 4 crores. Is the turnover within the limit? Yes, it is less than 40 crores. So yes, this is a small company. Wait, what is the name of the company? It is A Limited, which means what? This is a public company. So a public company, even if it is satisfying the requirements, even if it is not exceeding the threshold limit, it will not be a small company. So in the first situation, what will our answer be? Not a small company. Why? Because it is a public company. So a public company, even if it is meeting the threshold limits, it will not be termed as a small company at all. Then the next point here is, next example is, let's say X Private Limited. Let's say the paid up share capital is 2 crores, turnover is 50 crores. The conditions are AND conditions. Is the paid up share capital condition satisfied? Yes, it is satisfied. Is the turnover condition satisfied? No, it is greater than 40 crores. So in this situation, can we say X Private Limited a small company? It is a private company. So yes, we can go check the threshold limits. So again, no, it is not a small company. Let's take another example. Next, PQR Private Limited. Let's say the paid up share capital is 1 crore and turnover is 20 crores. Is the company a public company? No, it is not. Is the paid up share capital within limit? Yes, it is. Is the turnover within limit? Yes, it is. So yes, this is a small company. So in order to identify whether a company is a small company or not, what are the things we check? 1, it should not be a public company. 2, threshold limit, paid up share capital not exceeding 4 crores and turnover not exceeding 40 crores. And also it should not be a holding company or a subsidiary company. It should not be a section 8 company or a company formed under some special act.